Welcome to another edition of Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. August is back to school month, so I think it's fitting to cover an education-related topic. So for this edition, I'm going to be talking about how 529 education savings plans work. For starters, I do want to say that there are a lot of different ways for investors to save for future education costs, and 529 plans are just one of them. I think step one is to sit down and have a conversation about what your goals are for paying for future education. Let's take college, for example. Do you want to fully fund your child's college education? Do you only want to cover a certain number of years or a certain dollar amount? And do you want flexibility with your money in case your child chooses to go a different direction, possibly other than college? Once we've identified your goals and what you want to accomplish as parents or even grandparents, we can then kind of back into what saving strategies and investment vehicles make the most sense for you. But for investors who have a goal of wanting to accumulate funds specifically to be used for future education costs, a 529 savings plan is a really popular choice these days. A 529 account is a tax-advantaged investment account that is really designed to help families save for future education costs. And if you notice, I keep saying future education costs instead of using the word college. That's because nowadays, these 529 accounts, they're very flexible on how the money can be used. Apart from just being used for traditional college, the money in these 529 accounts can now also be used for kindergarten through 12th grade tuition. They can be used for vocational schools or apprenticeship programs. And even some money can be used for student loan repayments. One of the main benefits of the 529 accounts is the potential for growth on your money. 529 plans are normally offered by financial institutions, which also then offer the account holder the ability to invest the money with the goal of achieving long-term growth. Typically, you can be as aggressive or as conservative on the investments as you would like, and you can make changes to your investment lineup over time as your child gets closer to their education goal. So just like any other investment vehicle, when you're getting the benefit of that compound interest and that potential for growth of your money over time. The other main benefit of the 529 account is the tax advantages. So the earnings inside the 529 account grow tax-free, and the withdrawals that you take out of the account are also tax-free when the money is used for qualified education costs. So for example, if over an 18-year period, let's say you contributed $50,000 out of pocket into the 529 account, and now it's grown to $150,000. So all of that money is tax-free when it's withdrawn, as long as it goes towards these qualified education expenses. What counts as qualified education expense? Generally, that's going to include tuition, room and board, books, computers, school fees, really any other required materials that the student needs for the pursuit of their education. Unfortunately, spring break trips are not on that list, but the actual list of qualified education expenses is extensive and available so that you can check and make sure the money coming out of the account is going towards an expense that is considered qualified. Now, some 529 plans offer double tax advantages. Some states have their own official 529 accounts, which offer extra benefits to their state residents. For example, in Illinois, we have a couple of different 529 accounts that offer Illinois residents the potential to take tax deductions on the contributions that they make to the account up to certain limits. So Illinois residents, if they use the Illinois-sponsored 529 plan, they can potentially get those state tax deductions on their contributions, and then they get that same tax-free growth and tax-free withdrawals. So when you get to the point where you're researching 529 plans to see which one makes sense for you, I would start by checking to see if your state offers an account that might offer some of these additional tax benefits for you. Now, when I'm discussing 529 accounts with clients, there's usually two common questions that I get from clients. First question, will this account affect my ability to get financial aid? The short answer is yes, but it depends on how the 529 account is set up and how it's owned. And typically that impact to financial aid is very minimal. I would argue that the benefits of contributing to a 529, especially when your child is young, that's going to outweigh the minimal impacts that it could have when you're going to apply for financial aid. The second question I commonly get is, well, Nick, if I've been saving money into my child's 529 account for years, but then they decide not to pursue a higher education, what happens to the money? Well, for starters, there's no time limit on you having to use the funds. So you can keep that money in that 529 account as long as you want. Maybe your child changes their mind in the future. That money could always be there for them. If it's very clear that that money will never be used for the child that you intended it for, one of the options for you is you can always change the beneficiary to somebody else. Maybe there's a sibling or a cousin or a grandchild, whoever. You do have the ability to change the beneficiary to somebody else. And now there's a newer option that's available. If you've got leftover money in a 529 account, you can possibly roll up to $35,000 out of the 529 account over into a Roth IRA account for your child to jumpstart their retirement savings. But if none of those options are going to work for you, then the last resort, you can cash the 529 account out, keep the money for yourself, subject to taxes and penalties. So normally, you're going to pay federal income tax and an additional 10% penalty on the earnings inside the account. So as an example, again, if you contributed $50,000 out of pocket and the account has grown to $150,000, that $100,000 in profit, that's what you would be taxed and penalized on. And on the state level, some states could also claw back and take back some of the state tax deductions that they let you have on your contributions. So before you go down that route, you're going to want to make sure you have explored all your other options for that unused 529 account money. Those are some of the main points on how a 529 account works. But when you're picking out a plan, you also want to spend a good amount of time researching the investment options that are offered by the plan and have a good understanding of how the fees work. Those two things can either work for you or work against you. So it's very important to do your research there, or save yourself some time, work with a financial advisor such as myself, and we can help you explore these account options and hone in on which one's going to make the most sense for you. If you have any questions on 529 education savings accounts, or you want to spend some time discussing if they could possibly make sense for you, don't hesitate to reach out to me. Otherwise, thank you for watching and look forward to talking with you again soon.